Financial accounting. 12. BRS Bank Reconciliation Statement. Lotus Education Institute. Complete Coaching and Career Counseling.
Bank Reconciliation Statement. Bank reconciliation statements is a statement prepared by the account holder on a particular date to reconcile the bank balance as per cash book with the balance as per bank statement or bank passbook, showing entries because of which differences between the two balances exist. Transactions of deposits and withdrawals during the period being recorded in both cash book and bank statement or passbook. Balances shown by the two records at the end of the period should normally agree, i.e., should be same. But sometimes the two balances differ. If the two balances differ, it is necessary to know the reasons for the difference, as it may require entry to be passed in the books of account. A statement showing the reasons or causes of differences is prepared. This statement is known as Bank Reconciliation Statement. Bank Reconciliation Statement is prepared under the following cases. 1. When statement balance is debit, i.e., favorable balance as per cash book. 2. When starting balance is credit, i.e., favorable balance as per bank statement or bank passbook. 3. When starting balance is credit, i.e., overdraft, unfavorable balance as per cash book. 4. When starting balance is debit, i.e., overdraft, unfavorable balance as per bank statement or bank passbook. Points to be noted while preparing bank reconciliation statement. Balance. Which balance, i.e., cash book or bank statement or bank passbook, is the basis of bank reconciliation. In this regard, it should also be kept in mind. 1. Balance as per cash book means the balances are per bank column of cash book. 2. Debit balance or favorable balance in cash book means that the amount is lying deposited in the bank. It is an asset of the firm. 3. Credit balance in the cash book means overdraft balance, i.e., withdrawals are in excess of deposits. It is a liability of the firm. 4. Credit balances or favorable balance as per bank statement or bank passbook means that the amount is lying deposited in the bank. It is an asset of the firm. 5. Debit balance as per bank statement or bank passbook means overdraft balance, i.e., withdrawal are in excess of deposits. It is a liability of the firm. What is Bank Reconciliation Statement? Bank Reconciliation Statement is a statement prepared to reconcile the bank balance as per cash book with the balance as per bank statement or bank passbook. The reasons for differences are ascertained and presented in the statement. Why is Bank Reconciliation Statement prepared? Bank Reconciliation Statement is prepared to determine the reasons for differences between balance as per cash book and balance as per bank statement or bank passbook. State any two reasons of difference: cash book and bank passbook balances. 1. Checks deposited but not credited. 2. Checks issued but not presented for payment. What does debit balance as per the cash book mean? Debit balance as per cash book means amount lying deposited in bank. What does credit balance as per the cash book mean? Credit balance as per cash book means amount overdrawn from the bank. What does debit balance as per the bank passbook mean? Debit balance as per passbook means amount overdrawn from bank and thus payable to bank. What does credit balance as per the bank passbook mean? Credit balance as per passbook means amount lying deposited in the bank. When you proceed to reconcile the bank account starting with debit cash book balance, how is the following dealt with and why? 1. Checks issued but not presented for payment. Checks issued but not yet presented for payment are added because the bank will show higher balance since the checks have not been paid. 2. Checks deposited but not yet credited. Checks deposited but not credited are deducted because the bank will show lower balance as the checks have not been realized by the bank. 3. Bank charges charged by the bank not recorded in the cash book. Bank charges are deducted because the bank has already debited the account and thus, cash book shows higher balance. 4. Interest allowed by the bank not recorded in the cash book. Interest allowed is added because the bank has already credited the account and thus, cash book shows lower balance. When you proceed to reconcile the bank account starting with credit cash book balance, how will you deal with 1. Checks issued but not yet presented for payment are deducted because bank shows lower overdraft balance. 2. Checks deposited but not cleared are added because bank shows higher overdrawn balance. 3. Bank charges are added because bank shows higher overdraft balance. 4. Interest allowed is deducted because bank shows lower. Is bank reconciliation statement a part of double entry system? No, bank reconciliation statement is not a part of double entry system. It is a method to reconcile the two balances. Is it correct that bank reconciliation statement is prepared once, i.e., at the end of the year? No, it is not correct. It can be prepared at any time of the year, say every month or every quarter or half yearly or yearly. How will direct payment by a customer affect the passbook balance? 1. Increase the credit balance as per passbook. 2. Reduce the debit balance as per passbook. State two transactions which may be recorded in cash book but not in passbook. 1. Checks issued but not presented in the bank for payment. 2. Checks deposited into bank but not credited or collected. State two transactions which may be recorded in passbook but not in cash book. 1. Interest allowed or credited by bank. 2. Bank charges and commission charged by the bank. State two errors committed in cash book which are considered while preparing bank reconciliation statement. 1. Overcasting or undercasting of bank column of the cash book. 2. Wrong amount recorded in bank column of cash book. State the need for the preparation of a bank reconciliation statement. Preparation a bank reconciliation statement is necessary for the following reasons. 1. It helps in identifying the difference between cash books and passbook. 2. It helps in knowing the actual bank balance. 3. It helps in the detection and prevention of fraud and errors in recording banking transactions. 4. It helps in creating a revised. What is bank overdraft? Bank overdraft is created when there is a withdrawal, which is over the bank balance available in the account. It is an obligation to the account holder. Briefly explain the term favorable balance as per cash book. When the total of the debt column of the cash book is more than the total credit column of the cash book, it is known as debt balance or favorable balance. A favorable balance is an asset to an account holder. A favorable balance can also be defined as a surplus of deposits over without. State the causes of difference occurred due to time lag. The following are the causes of difference occurred due to time lag. 1. Check issued by the firm is not presented for payment. 2. Check deposited in the bank but yet to be realized. 3. Direct debits done by the bank on behalf of the customer. 4. Amount deposited directly into the bank account. 5. Interest and dividend that are not collected by the bank. 6. Direct payment made by the bank on behalf of the customer. 7. Explain the reasons where the balance shows by the bank passbook does not agree with the balance as shown by the bank column of the cash book. Here are some of the reasons which result in a mismatch between the bank passbook balance and cash book. 1. Time differences. Checks issued by the firm but not yet presented for payment. Checks issued by the firm to the suppliers or creditors are immediately recorded on the credit side of the cash book. However, there will be a time gap when the receiving party presents it to the bank. So the bank cannot debit the amount. It will result in changes in the balance amount between the two books. Checks are deposited into the bank but not yet collected. A firm receives checks from its debtors' customers, which are then immediately recorded on the debit side of the cash book. However, when those checks are deposited in the bank credits the firm's account only after the checks are actually realized. It creates a difference between the two balances. Direct debits made by the bank on behalf of the customer. Bank deducts various charges like check collection charges, interest on overdraft, and check bounce charges. The firm will not be aware of such debits, and hence these changes will not be reflected in the firm's cash book. Due to this reason, the cash book will not be in sync with the passbook. Amounts directly deposited in the bank account. When debtors or customers directly deposit money into the firm's bank account, the firm will not be aware of such deposits. Due to this, these entries will not be recorded into the cash book. This will also create an imbalance between the bank passbook and interest and dividends collected by the bank. The bank collects interest and dividends on behalf of the customer. It will not be known to the customer and hence will not be recorded into the firm's cash book. This creates an imbalance between bank passbook and cash book. Direct payments made by the bank on behalf of the customers. When the customers give standing instructions to the bank for making payments to third parties, like paying telephone bill, insurance premium, rent, taxes, etc., the firm will not be aware of these payments, and hence such insurance will not be recorded. Checks deposited and bills dishonored. A check deposited by the firm if dishonored or a bill of exchange drawn by the business firm which is discounted with the bank is dishonored on the date of maturity, the same is debited to customer's account by the bank. This information is not available to the firm immediately, and it will not be recorded in the firm's cash book. This will also create an imbalance between the bank passbook and the firm's cash book. Differences due to recording errors. Errors committed in recording transactions by the firm. When a wrong recording of transactions relating to incorrect totaling, checks issued, checks deposited, etc. are committed by the firm in the cash book, it will create an imbalance between the bank passbook and the firm's cash book. Errors committed in recording transactions by the bank. When a wrong recording of transactions related to checks issued, wrong totaling, checks deposited, etc. are committed by the bank in the passbook, it will create an imbalance